Good afternoon to you all. Usually, Zentax is associated with GST only. Mainly, our topics are focusing on various aspects of GST. Even after having conducted so many webinars, still there are many areas or aspects to be covered under the GST. But there is a similar requirement we felt is required in the income tax front also. Why? As you will be aware of the fact, the new Income Tax Act 2025 has come into effect from 1/4/26. So many of the participants expressed their desire that we must have a session for the income tax also. So we thought we shall have some of the sessions fully dedicated for the new Income Tax Act 2025. See, the 2025 Act, it is not bringing in new concepts. As one of the speakers in which I attended told that the lawmakers were given a clear instructions not to tamper with the provisions. The persons who wrote the new law, Income Tax Act 2025, their task was to write the law or the erstwhile 1961 Income Tax Act in a simple language which is understandable by each person. So that was the object with which the new act has been enacted. So there will not be much of change in the concepts, and also it cannot be changed overnight. The concepts from 1961 or even the earlier act, 1922 Act, everything remains the same. The concept remains the same. Okay, what is the reason for the so many changes in the Income Tax Act? Because you will see there are so many sections, say 128A, B, something like that. Various sections are there. Why? See, because of the various interpretations given by the courts, the chartered accountants and then lawyers interpret a legal provision in such a way that they are able to convince the court this view is also possible. When the government comes to know, yes, this view is possible, and then there is a revenue leakage in this way, then they try to plug it through amendments. For example, the earliest Supreme Court judgment in the case of Sunil Siddharth Bhai. So whenever there is a person is introducing capital and then there is a retirement, there will not be any capital gains, or if there is a dissolution, there will not be any capital gains. To counter that, Section 45(4) was introduced, and then 44(5). All these concepts were there to nullify some of the decisions rendered by the courts. So the bulkiness or the various sections with the numbers or the letters is only due to the various interpretations given by the chartered accountants and the lawyers in interpreting to reduce the tax liability. So to counter that, so many amendments are there. So they are making. In the similar manner only, the amendments were made to the Income Tax Act 1961. It made very, very bulky. And the language was also very, very complicated. So many provisos were there. So many provisos were in the, for example, earlier section 10, subsection 23C. You can count the number of provisos. It will be very, very lengthy provisos. So to give it a simplified version only, this 2025 Act has come. All the provisions will be the same. For example, 40A3. See, 40A3, the 10,000 above, you cannot make the payment. The similar thing is there in the Act also. 2025 Act also, the similar provisions are there, but in some other place, where it is at Section 36, subsection 4. So the same amount, you cannot make the cash payment above 10,000. It was there in the earlier Act. The same thing remains in the current provisions also. But in the words are simplified. Words are simplified. So this is the major change that has taken place. And also the income tax portal. Income tax portal has got a beautiful way that we can compare the earlier section and the current section so that we can understand it in easy manner. You need not go to some other sites or anything. You can use the government portal to get a clear understanding of the provisions. What was the earlier provision? What is the new provision? They give what is the corresponding provisions in the new act. All those interrelations are in the portal itself. You can go through that and then you can understand. For example, 192 in the 1961 Act. This is a TDS provision for salaries. Same is that, where it is the 392. So these types of only the numbers are changed, the contents or the concepts remain the same. But still, we have to enlighten our valuable audience about the changes and then where to look into those aspects has to be required. So in this background, we have got our expert, Kadirvel, Chartered Accountant, who is part of our team, who is dedicated to this new act, and then he is, and everyone is learning. I would say, see, I have been in practice for more than 30 years. I cannot say I am the expert. Now, the level playing field has come. So, Kadirvel is also learning. I am also learning. In this background, Kadirvel is going to give you about the deduction under the profits and gains and the profession. So, he is going to talk about you, or he is going to enlighten you all about this concept of for the deductions. Now, I give the entire session to Kadirvel. He will be explaining, or he will be giving in detail what are the contents or the new concepts in the deduction area for the computation of income under the head profits and gains of profession. Thanking you for your continued participation. Now it is over to Kadirvel. He is also expert member. Kadirvel, over to you.
Thank you for your brief introduction, sir. I am Kadirvel, Chartered Accountant from Poland LLP, student of the Mr. Our Chief Mentor, CAP Paul Tangam, sir. And good afternoon, everyone. Welcome to today's webinar. The topic is on profit and gains, business and profession, especially deductions under the Income Tax Act. I am delighted to have you all here today.
Slow.
Particularly, I will be your guide through what is arguably the most significant head of the income under income tax law. This is particularly PGBP income. So before we begin, let me give you a sense what the session will cover. A thorough section by section walkthrough of all deductions permissible under the PGBP. Real life with real life practical examples too. A clear understanding of what is deductible under PGBP and what is not, and critical conditions that determine the differences and common mistakes the assessees and practitioners made in day-to-day life and how to avoid them. Okay, let me go to the presentation. Okay, actually, let me walk through a roadmap of what we will cover today. There is 6 models here we will cover. First one will be the overview of PGBP. This is the basic foundation. What is exactly a PGBP income and what gets included and what gets excluded? This was covered in the section 26. And we will come to the model 2. This was the business expenses, rents, repairs, insurance, employee welfare. That was the first layer of the deductions. Then we will come to the model 3. That was the bad debts and variety of other specific deductions like that. And model 4 will cover the depreciation framework, the most favored section in the PGBP. And model 5, this is the conditions and restrictions of the general and specific conditions for the deductions. And we will finish with the model 6, which was deemed income provision, balancing charges, and impact of the foreign exchange fluctuation of assets cost. Okay, let me go to the first model. That is an overview of PGBP. And what is charged under the PGBP? This is covered under section 26. Section 26(1) of the 2025 Act provides that the income referred in the subsection 2 shall be the chargeable to income tax under the head PGBP. Okay, so let me go to the section 26(2). Section 26(2)(a) given about the what is the business and profession income. The most obvious inclusion is the profit and gains of any business or profession carried on by the assessee at any time during the tax year. Note the words, that is any time. Even if the business is carried for simply for 1 day or 1 month or 15 days or 5 months, that that profit from the businesses should be chargeable under the head PGBP. Okay. Then we will come to for compensation receipts. Compensation receipts is under the section 26 2B. Any compensation or payment received for the termination or modification of management office other that should be chargeable under the head PGBP income. It is important to know that this section prevents the assessee from arguing in the compensation of the end of the business relationship is a capital receipt. There are three specific situations that are covered here. Whoever the managing the affairs of the Indian company or managing affairs of the India in a foreign company, whoever holds the agency in India for any part of another business of person and for any contract relating to business. Then you will go to the government compensations. This is covered under section 26 2C of the Income Tax Act. When the government takes over the management of any property or a business and pays compensation to owners, the compensation is taxable under the head PGBP. This most probably applies in the nationalization schemes. Then we will come to the trade association income. It is section 26 2D. Income derived by trade, professional or similar association from a specific activities performed by the members is taxable. This is the mortality principle exemption, because normally mutual income member to member is not taxable, but there is a specific services breaks the mutuality shield. I will give me an example. There is an All India Exporters Association charging members a fee of ₹2,000 for a consultation fees of legal services rendered by its in-house legal team. The specific service income taxable under PGBP, even though it flows from its members itself. So that is the specific provision here. Okay, then we will move to export incentives. Profit on sale of import licenses, we will give duty drawbacks and duty remissions. These are all chargeable under the head export incentives. Then perquisites from the business. The head purchase from the business is covered under section 26 2F. The value of any benefit or perquisites, whether convertible into money or not, whether in cash or kind or partially both, arising from the business or profession, is taxable under the head PGBP. Okay. Then we will move to the key inclusions in the PGBP income. Okay. Then 26 2G, partnership remuneration of the firm. Then now recently TDS also introduced the partnership remuneration. Okay, we'll go to the subject. Any interest, salary, bonus, commission, remuneration, whatever name called, it is received by the partner of the firm from the firm is taxable in the hands of the partner under the head PGBP. But there is a critical qualifier here. Only to the extent of deductions allowed to the firm under the head PGBP is chargeable here. In simple terms, a firm gets the deductions for the remuneration paid to the partner will show us an income in his accounts. If it was disallowed, then it will not be chargeable under the head of the PGBP for the partners. Okay. Next, we will come to the non-compete and non-disclosure receipts. This is covered under section 26 2H. Any sum received under an agreement for not carrying out any activity in relation to business or profession, or not sharing any know-how, patent, trademark like that, or similar commercial rate is taxable under the head PGBP. There is an important exemption also, that if there is a sum received for not carrying out an activity which could have been taxable as a capital gain, then it will be taxable under the head capital gain, not under the head PGBP. Okay. Then keyman insurance policy. Any sum, this is covered under section 26 2I. Any sum received under a keyman insurance policy, including bonus on such a policy, is taxable under the head PGBP. What is keyman insurance policy? It is an insurance policy taken by a company on the life of an employee or key person who loss would significantly hurts its business. The company pays the premium and claims the premium as a deductions. When its policy matures, then it should be taxable under the head PGBP of the company, because while paying the premium, the company is getting the deductions. So while maturity, it should be chargeable under the head PGBP, because it is that the preference, the abuse of tax-free wealth accommodations. That's why. Okay, we'll go to fair market value of inventory converted into capital assets section. This is covered under section 26(2)(j). This is most probably applicable to the real estate companies, when any inventory is converted into or treated as a capital asset, the fair market value of such inventory on the date of conversion, is deemed to be income under the PGBP. This plugs a potential tax avoidance loophole here. For an example, a builder has 5 flats as a stock in trade. He converted 2 of them into one personal property. The FME of those 2 flats on the date of conversions will be charged as a taxable under the head PGBP income. Next, we will come to section 26(2)(k), which is sum received on demolition of assets. When the capital asset other than land or goodwill is demolished or destroyed, and the entire expenditure, it was allowed as a deductions under section 46, and then any amount receivable as under the charge under the head PGB, because the logic is you get full deduction on the asset cost. When you recover something on disposal, you must be show it as an income. We will move to next one. This is the special provisions 26(3) and 26(4). 26(3) is for speculative business, where an assessee carries on a speculative transaction on such nature, they constitute a business. The speculative business is deemed to be distinct and separate from it should be separate from any other business the assessee carries on. Why this matter? Because losses from speculative business can be only set off against the profit of the another speculative business, not against any other income. This creates a ring fence around the speculative activity. I will give you a most common example. Mr. Suresh runs a garment business and he earns a profit of 8 lakhs, and he trades in a commodity futures too, and he make a loss of 5 lakhs. Because of commodity trading, he made a loss. He cannot set off the speculative loss into the income of the garment business. So the speculative loss should be carried forward, and it should be set off against only future year speculative profits only. Many practitioners or assessees will set off the speculative losses to non-speculative income. So it will be wrong. It is incorrect. So always check the nature of transactions before setting up. Then section 26(4). This is residential house income. This is an important exclusion provision. Income from letting out a residential house is not included in the head of the PGBP. Such income is chargeable only under the income from house property. This section applies only owner lets out the property, not when the tenant sublets it to it. Then you will come to business expense deductions, model 2. Okay, this in section 28 covers rent, rates, taxes, repairs, and insurance. Okay, you will come to first section 28(1)(a), which is insurance premium. Any premium paid for the insurance against the risk of damage or destruction of business premises, machinery, plant, anything. Commonly, the standard fire and burglary insurance, everything will be allowed as a, because it is for the business purpose. It was allowed as a deduction under the head. Okay, next we will come to repairs of the owner. I mean building. It is covered under 26(1)(d). When the assessee occupies a premises other than as a tenant, I mean it was a owner, he was spent something for repairs, he can claim as a business revenue expenditure under the head business or professions. There is a critical distinction in this. That current repairs means day-to-day maintenance only. There is a capital repairs also. What is capital repairs? Capital repairs means the extent of there should be extent of life or add new features to the assets. So for those things, we should capitalize the amount and we should gain the deductions by depreciation only. We should not directly charge as a revenue expenses. Okay, then we will come to tenants repair obligations. I was told that the expenses paid by the owner, but next we will come to the tenants repair obligations. Section 28(1)(e) provides that when the assessee occupies the tenant and has contractually agreed to bear the repair costs, those repair costs are deductible. This is tenant specific. If the tenant is not agreed to bear the repairs, even if he pays for the repairs, the deductibility is questionable. So it is better to make an agreement before making the repairs. Then repairs to machineries. Routine repairs to machineries, plants, furniture used for business purpose are deductible under the revenue expenses. It is not able to charge on capital. Then section 28(2). It is an important section. It premises the assets which was partly or not wholly exclusively used for business purposes. This restricts the proportionate part of the deductions only can be claimable by the assessee. Because if your business, if you are running the business, if you are using the car, only 20% of the car is used for the business purpose, means we should only claim the 20% of the depreciation. We'll move to next. Then we will move to employee related deductions. Section 29(1)(a), recognized provident fund. Contribution to a recognized provident fund or approved superannuation fund are deductible within the limits prescribed under the Act. The key is here the fund must be recognized. It should be approved by the Commissioner of Income Tax. If it was not approved by the Commissioner of Income Tax, it will not be deductible. And NPS contribution, it was covered under section 29(1)(b). The employer contribution to the national pension scheme is deductible up to 14% of the employee salary. The salary for this, the salary includes dearness allowance too, but it excludes all other allowances and perquisites. The ceiling of 14% came under Income Tax Act 2025 only. Earlier 1961 Act, it was the 10% only. It was an update for in the new Act. Next, we will go to approved gratuity fund, section 29(1)(c). Contributions to the approved gratuity fund created exclusively benefit of the employees under an irrevocable trust. That only deductible. Irrevocable trust means once contributed, employer cannot get it back. That's right. Then provisions for gratuity. Any provision made for making a contribution of the approved gratuity fund, payment of gratuity that has become actually payable during the tax year is deductible. This allows recognition of gratuity liability before the actual payment. Then employee PF contribution. This was the section. Many people are making some common mistakes. I will tell you that this was covered under section 29(1)(e). The employer can deduct the employee's own contribution to PF, which was deducted from the employee salary, but only if it was credited to the employee's account in the relevant fund due date specified in the relevant act. For example, if you get the employee's contribution from the for PF and the due date for is 15, but you are paying it for 17, you cannot able to get the deductions. In previous 2 to 3 years back, there was some case laws. We can get the deductions if you paid before the filing of due date of return. But now it was nullified. We can only should pay at the due date of the relevant act only. Okay. In employee welfare restrictions, we'll go for section 29. Section 29(3) is a negative provisions. It says no deductions shall be allowed for contributions to any fund, trust, or company AOP unless it is specifically framework under the section 29(1)(a), B, C are required by some other law. This prevents employers from creating a informal welfare funds and claiming unlimited deductions. So only formal and approved structures only qualify for these deductions. Then We will go to section 30, insurance premium for stock, cattle, and employees. Because these three deductions are insurance premiums are not covered in section 28. That's why it was covered here. Section 30A is insurance for stock and risk of damage, like that. Section 30B is insurance for life of the cattle owned by the members of the primary cooperative society engaged in supplying milk to the federal milk cooperative societies. Then section 30C is employers insurance on health of the employees. It will cover that. Then we will come to model 3, bad debts and other deductions. Okay, in deductions about bad debts, there will be two broad categories. One is provision for bad debts and writing of bad debts. In provision of for provisioning of bad debts, only financial entities are allowed. For most of the other than financial business, we cannot claim the deductions for provisioning of the bad and doubtful debts. Okay, how much we can make a provision? There will be a rule. For Indian banks and cooperative banks, up to 8.5% of the total income plus additional 10% of the aggregate advances of the rural branches. For that, the Indian banks and cooperative society can make a provision for bad and doubtful debts. Foreign banks and PFIs, NBFCs can make a provision up to 5% of its total income before these deductions. Then we will come to actual write-off section. This is section 31(2). It will be covered for all assessees, including non-financial business peoples too. The actual bad debt written off as irrevocable in the accounts can be deductible as expenses. But there should be key conditions. The debt must have been included in the income of the assessee. Whether, for example, if you are writing off the bad debts against the sales should be shown as income at the time of sales has happened. The amount must be actually written off in the books of accounts of in the relevant tax year. Mere provisioning only will not be deductible. Recovery of the previous written off bad debt. This was covered under section 31(2)(t). What will, if I was written off the bad debts in previous year, from this tax year, I was recovered something. What will so? So previously, if I was got the deductions, if I was recovered, it should be taxable under the head profit from business or provisions. Then we will go to next section. Other deductions. This is under section 32. Bonus or commission to the employees. Bonus or commission to the employees is usually allowed, but only if would have been paid to the employees for their work rendered. Because some people will do distribution of profits or shareholders, like that, they will distribution of dividends they will do. So in that type, it will not be allowed. Then interest on borrowed capital. Interest on capital borrowed for the purpose of business or profession, it should be deductible. But there is an important exclusion. Interest on capital borrowed for payment of tax is not deductible, because payment of tax is not allowed as a deduction under the Income Tax Act. So for making the payment of tax, if you are borrowed, the interest also will be disallowed. Then discount on zero coupon bonds. This is covered under section 32(d). For zero coupon bonds, there will not be any specific periodic payment of interest. The returns comes only the difference between the issue price and the redeemable price. Section 32(d) allows deductions of the zero coupon bonds pro rata amounts of discount. Like let me give an example. If NHAI issues zero coupon bonds to fund highway constructions, issue price of the per bond is ₹700. The redemption value of the bond is ₹1,000. The maturity period is take it as a 5 year. Then discount is ₹300. Annual pro rata deduction would be ₹60 per bond. Then we will go to special reserve. That is section 32(e). Specified financial entities like banks, public financial institutions, housing finance companies can create and maintain a special reserve and claim deduction amount to transfer. But there is a 3 specific conditions for that. Amount transferred must not exceed 20% from the eligible business before its deductions. Then aggregate reserve cannot be twice of the paid up share capital plus general reserve of the entity. Then eligible business means they're providing the long-term finance for industrial or agriculture development or housing finance. Then we'll go to next. Sugar cane purchased by the cooperative society. This is covered under section 32G. For the cooperative society, for manufacturing sugars, it may get the sugar cane from the farmers. Usually, if it gets, the deduction is allowed up to price equal to or less than the government fixed. For example, if for a ton of sugar cane, the government price is fixed for 5,000 rupees. The cooperative society can pay up to 5,000. More than 5,000 it pays to the farmer. It will not be allowed to get as a deduction under the head business. Then market to market loss. The market to market loss or other expected loss as computed under the ICDS provision under section 267 only are deductible. Then we will come to family planning expenditure. Family planning expenditure incurred by covered under section 32I. Expenditure incurred by the company for promoting family planning among its employees is deductible. There is a unique features in this deductions. There is a revenue expenditure we can do and also capital expenditure. If you are getting a revenue expenditure, it was fully deductible and the year it was accrued. If you done capital expenditure like buying some machineries to the primary health center like that, you can bifurcate into 5 years and you can get the deductions. And securities commodity tax and commodity transaction tax. It is paid in the course of business or deductible, provided that the income from those transactions also included in the PGBP. And then animal loss deductions. There is a difference between it is covered under section 32J. Difference between the actual cost of animals used for the business and amount realized from the carcass. Carcass means dead body. Well, animals are died or become permanently useless, that will be the then we will come to depreciation. For depreciation, what are the eligible assets? Eligible assets are covered under section 33(1). Depreciation is available only 2 categories of assets: tangible assets and intangible assets. Tangible assets cover building, machinery, plant, furniture, etc. Intangible assets, know-how, patents, trademarks, license, etc. But there is an important exclusion. There is a goodwill of a business or professions is not eligible for depreciation. Okay. What are the conditions for claiming the depreciation? Asset must be owned by the assessee. The asset must be used wholly and exclusively for the business or professions. Depreciation is allowed whether or not, there is an important line. Depreciation is allowed whether or not the assessee has actually claimed in the return. However, the WDV will still reduced by the allowable application. To put an example, for this year, many people will say like, for this year, I will not claim the depreciation. So I can claim this depreciation to the next year. We cannot do that. As per the Income Tax Act, if your claim or not claimed, the WDV will be reduced year by year. And section 33(4), there is a 50% rule, 190-day rule. If an asset is acquired and put to use for less than 180 days in the relevant tax year, the depreciation deduction is restricted to 50% of the depreciation for that year. Okay. There is an additional depreciation called under section 33(8). It is an incentive section for the manufacturers, because in addition to the normal depreciation, there is an you can claim 20% extra depreciation for the new machinery. For that, some conditions are there. The assessee should be engaged in manufacturing, production or generation, transmission or distribution of power. The new asset was not previously used by any other persons. It was not it should not be installed in any office premises or residential accommodation. It should not be not an office appliances. It should not be not an asset which was 100% deductions was already allowed. If you satisfy those conditions, you can claim extra 20% of the depreciation. But if you put to use for less than 180 days, the difference of you can claim additional depreciation only up to 10%. The remaining 10% you can claim immediately in the succeeding year. You can claim that. We'll go to amalgamation. Section 33(5). What is the depreciation for the amalgamation, demerger, and succession? When the ownership of assets changes to the amalgamation, demerger, or succession, the aggregate depreciation for the predecessor and successor entities cannot exceed the depreciation that can be available had the transaction which was not happened. Let me give an example. If P Limited is merges into Q Limited, it was used, P Limited was total number of days was 170 days, and Q Limited was more than 170 days. For that, P Limited can claim 50% of depreciation, and you can ask Q Limited can claim 100%. No, it should be it should not be the maximum allowable depreciation. It should be if the amalgamation, demerger, or succession which was not happened, that maximum amount only you can claim. Then leasehold improvements. It was covered under section 33(6). If an associate occupies a building on lease for a business purposes and incurs a capital expenditure on that building, if you done that, it was for the depreciation purpose, it was the treated as a capital asset, and we can claim a depreciation too. It is a very practical and beneficial provision for the tenants who was improving the leased premises. And deficit rate of premises. Well, total WDV of the asset is sold, but you have the something amount in the balance in the asset side. So you can write off that amount into P&L and you can get the deductions. And we will move to next, unabsorbed depreciation, which was section 33(11). This is the most powerful provision in the depreciation framework, because if the business profits are insufficient and not to absorb the full depreciation in the tax year, the unabsorbed amount can be carried forward to indefinite period. It is treated as a depreciation for the succeeding year, and also it can be set off against any head of income except the salary. We will come to the cost of assets. What will be the cost of assets for depreciation? Depreciation is computed on the actual cost of assets actually. So section 39 tells you how to compute the actual cost. So actual cost of asset will be the, if you for acquiring the asset, if any person other than the assessee was paid, it should be reduced. And if you paid the GST and taken the input, this was most people commonly do the mistakes in this area only. They will claim the input in GST and also claim the depreciation for the invoice value. It should be claim. We should add the cost of asset to the taxable value only. If you are excise duty, then if you get subsidy from the government, we should reduce that. And there is a cash payment restriction to the cost of asset also. Under section 39(2) tells that if the payments for acquiring an asset in a day exceeding rupees 10,000, then it should be excluded from the cost of the assets. Okay. What is the actual cost of under special situations? There is an amalgamation, demerger, inventory converted into capital assets. I will go one by one. For amalgamation, the same amount should be as a amalgamating company. If you are demerger, how much you will proportionately given to the demerger company, it should be the cost of that. Inventory converted into capital asset means fair market value of the date of conversions. If you gift or inheritance, it should be cost of the previous owner. If the building put to use for the business in current year only means, what is the first you should calculate what is the life of the building. What is the WDV if the building from the day one itself used for the business purposes, and then you arrive the WDV and keep it that as a cost of asset. If you're transferring the holding company to transferring company, the same amount should be the cost of the assets. Then we will come to general specific conditions. Okay. Section 34(1) is a residual reduction provision, which it means the expenses which are not covered under the specifically listed, which was 28, 30, 28 to 33, 44 to 49, 51, 50, any expenditure which was not covered the income of the covered under the Income Tax Act, it will be can claim deduction here, and it should not be in it should not be in a capital nature, and it's wholly and exclusively used for business purposes only. Then you will come to 34(2), not deductible even if laid out for business. If you are paid for business purpose only, but if there is a three absolute differences. First one is illegal expenditure. If some people are paying bribery or illegal ways to bribery or something, if your department is asking some bribery to the assessee, if you are paying that, for that you cannot claim the expenses. And the second one is 34(2)(b), that is a CSR expenditure. Expenditure on activities to corporate social responsibility under Section 135 of the Companies Act 2013 is not deductible as a business expenditure under Section 34. But there is a specific exclusion is if you donate to the PM CARES Fund and National Relief Fund as a part of CSR, you may qualify for the deductions. And the last section is 34(2)(c), political party advertisements. Expenditure by way of giving advertisement through the political party brochure, tract, pamphlet, like that expenses are disallowed, because this section prevents the indirect funding of the political parties. Then amount not deductible in certain circumstances. Some things are not deductible. Income tax and such as Section 35A covers income tax and such as tax paid on income. I have said that earlier itself for deductions itself. Tax paid on income tax for income tax paid, it will be allowed as a deductions. Then most important sections, Section 35B, it is for TDS default. Sorry. If any sum payable to residents on which TDS is deductible, but the tax has not been deducted or not has been paid by the due date specified under the Income Tax Act, is disallowed up to the 30% of the sum paid. But if the 30% disallowance only for the resident people. If you pay to the non-resident people, the 100% amount paid will be disallowed. Then you will come to partners' remunerations. How much remuneration can we give to the partner? There will be a specific calculation for that. You can see that for first 6 lakh of book profit, even there is a loss, or up to first 6 lakhs of book profit, you can claim 90% of book profit or rupees 3 lakh, whichever is higher. Over and above profit of 6 lakhs, you can claim 60% of the book profit as a partner's salary. That is an important thing. If you want to deduct the partnership salary as a partnership remuneration as a deductions, it should be authorized by the partnership deed. If the deed authorizes the remuneration but not specify the amount, still it will be allowable, because within the statutory limits. If the deed does not authorize the remuneration, the entire remuneration is disallowed, even though the statutory provision given you to deduction. And also remuneration relating to the prior date of the partnership deed is also not allowed. Then interest to partners. The maximum percentage allowed to partners is 12% simple interest per annum. Compound interest or any excess over the 12% of 12% rate is not allowed as a deductions. Then we will come to the related party transactions, Section 36(2). Expenditure to any specified persons. If the assessee pays a specified persons, and I will tell you who is a specified persons. If the assessee pays to a specified person, an amount that assessing officer considers excess or unreasonable, having regard to there is excess to fair market value of goods or services or facilities, there is no need for business, or actually benefit actually received was less than the amount which was paid, the excess amount will be disallowed. The specified persons include an individual or any relative. For a company, a director relative, you can see that. Okay. Then we will come to cash payment disallowance. Cash payment disallowance, as our chief Mentas as he said, it was 36(4), it was covered. Any expenditure, whether a payment or aggregate payment to a person exceeds in a single day rupees 10,000, it will not be allowed as a deductions. But there, for goods and carriage, there is a enhanced limit of rupees 35,000. Then some people will say, if I was maintaining the books in accrual basis, I have booked the expenses in previous year, and this year I will pay the cash totally. For that, this year it will be taxed under the business or professions. Okay. Then section 37 is a critical provisions, because that overrides the normal accrual based accounting for specified categories of expenditure. Even though if you maintain accrual basis or cash basis, that is not a matter here. For these expenses, it should be allowed only on payment basis. I will tell that, which was covered under section 37(2). First, tax duties, which was put provision, it should be payable before the due date. Then employees fund contribution, it should be also paid only, then only allowed. Then interest to financials, Indian Railways, all things. But there is a last point, 32(7)(g), payment to MSME dues. Because for all this, I will tell you an example. For PF employer contribution, for the tax year 26-27, for year ending March 2027, the employer should be having a provision of 8 lakhs. And here, the due date of paying, it was 31st October, but he was paid on November. So it was disallowed on that year and will be allowed in next year. For MSME alone, the due date is, which was specified in the MSME Act section 15, which was probably 45 days. So if you bought a goods on 31st March, your time limit only will be 45 days. If you pay on 46th day, before the due date of filing of return also, the expense will be disallowed in this year and will be allowed in next year only. Then we will come the deemed income and special rules. Cessation of termination trading liability. If there is any deductions allowed in earlier of trading losses, if there is a loss was there is a cessation or remission, it should be chargeable under the head business. Then balance in charge. I was already told in while calculating the depreciation itself. If an entire asset was sold, but there is some amount in balance, it should be deemed as an income. Scientific asset sold under section 38(1)(c), while getting the scientific research asset, you will get the 100% deductions. So if you sold the asset, whatever the remuneration received, you should be deemed as an income. Then recovery of bad debt. It is covered under section 38(1)(d). The bad debts, because return of bad debts allowed at the time of write-off, but now it was recovered, so it should be shown as an income. Then we just a second. We have allowed deductions for specific reserve to transfer of specific reserve. But if you are not using that for the specific thing, but you are taking back, it should be shown under the PGBP income. Okay. Then the last point, capitalization impact of foreign exchange fluctuations. I will give you with an example. If a limited company imports machinery from the Germany for 5 lakh euros, at the time of invoice, exchange rate was 10 rupees. For example, we can get the total cost of assets is 50 lakhs. But at the time of payment or 1 month or 2 month credit period, the amount was changed to 20 rupees. It will be 1 crore. So total cost of asset will be the 1 crore. It should be added. If you borrow also, the borrowing interest also should be added to the cost of assets. Here is all the total. We can come to the end of the session. Here is the summary of quick reference summary of all the sections we have seen. So you can take a look into that. Then thank you for attending the class. There will be next will be a question and answer session. You can ask your question, and thank you for all your attention throughout the webinar. I hope today's session will give you a clear and actionable understanding of PGBP deductions and the Income Tax Act. Then our chief mentor will give the vote of thanks.
Can you explain CSR and then PM relief point? See, CSR, that is what one statute casts an obligation. Companies Act casts an obligation on the companies to spend. Companies Act stipulates a percentage should be spent on CSR activities. So this is a forced expenditure on the company. But why it is not allowed? This is one of the fundamental questions. This was the position in the earlier act also. The same thing continues in the new provisions or the new act also. So for the CSR relief fund, you cannot claim as an expenditure, even though it is a mandate given under the Companies Act that you have to spend so much of amount for the CSR activities, but it will not be allowed. So, but in case of the PM relief fund, you can claim the expenditure. Even though it is in the nature of CSR, if the amount is contributed towards the PM relief fund, this being a government fund, and it is allowed as a expenditure. So one of the important aspects. So
Slide.
See, see, there was a request to show the Forex slide for a few minutes. We will send the entire PPT for the persons who are attending it. And another aspects that I want to tell is, see, you might have seen most of the provisions are similar to what was there in the earlier act or the preceding act, 1961 act. So earlier we had 43B. Now that has come in section 37. Now that has come in to 37. So the TDS non-compliance, see, only 30% will be disallowed only if it is for the local payments. If it is for a non-resident payment or related to a payment made abroad, if there is no TDS, then naturally 100% will be disallowed. So this is one of the important area that was there in the earlier provisions also, that has to be stressed and in the current provisions also. Then one of the thing is, see, for this is a first webinar for Kadirvel. He did it wonderfully. Hope everyone understood the concept, and then he has taken every efforts to go through the entire amount of deductions under the head profits and gains of business and profession. So he must be congratulated for that. And then one more change or one more addendum I would tell is, this is with regard to the employee benefit amount. Employee benefit amount. Okay, employee benefit amount, there is an amendment from 1/4/2026 itself. but this amendment is made by the Finance Act 2026. So what is that amendment? See, earlier, for the employee amount collected, it has to be paid by the due date. That is due date under the PF. So under the ESA provision, suppose you are collecting that amount, and if you do not make that payment as specified in that relevant act, that will not be allowed as a deduction. But some change has been done by the Finance Act 2026. So even if it is paid before the due date for filing the return, you can claim the expenditure. So this is one of the change that has come into my mind. So all the things are fully covered by the CA Kadirvel. It was a wonderful session, Kadirvel. And then thanks for all the person for your continued participation. If you have got any queries, kindly send it to us or by mail. We will be responding into your mails as soon as possible. Thanking you for all of your presence for this webinar. Thanking you.